This is really burning because this is really important. This is really burning because it's really important. Don't worry, it was only prop money. I know I'm gonna get flamed in the finance community for this one, but even though index funds recently hit another all-time high, and even though index funds have outperformed 95% of active investors over a 20-year period, on this channel, I'm here to provide insights and perspectives that are different than the textbook advice. When you're in the stage of building, growing your wealth, it's important to be strategic and take calculated risks. In this video, we're going to be talking about what index funds are, why I believe index funds could be going extinct, providing lower returns over the next several years, why mutual funds are objectively not great, and the best alternative investments for the highest potential growth. So if you're interested, make sure to stay tuned and watch until the end. Hey, what's up everyone? My name is Chris and welcome back to the Lifestyle Design Show, the #1 place for young adults to learn about personal finance and entrepreneurship. So before we jump into it, let's first talk about what are index funds. Well, I like to think of index funds almost like the Power Ranger robot, when they all come together and make one giant mega robot. Well, that's kind of what index funds are. Index funds are a basket of individual stocks. So the S&P 500, for example, is the top 500 US companies. Now, index funds are a time-tested strategy for growing your wealth. And I'm a big fan of index funds, even if it seems like they might be coming to an end. And the reason I say that is because there's no such thing as unlimited growth when you have limited resources. Now imagine 8 billion people all investing in the same Vanguard index fund and expecting a 15% annual return, when the world economy only grew 2.36% in 2019. And that was the year before the pandemic shutdowns. By the way, I have nothing to sell you, nothing to gain. All I ask is that you smash the like button for the YouTube algorithm. And that's pretty much it. Index funds were first created by Jack Bogle in 1975. The year after he started his Vanguard company. And Jack Bogle was a true American hero. He gave the working class an accessible and easy option to invest in the stock market at a low cost and low risk. Because that's one of the biggest benefits of index funds. Since you're investing in a basket of stocks, your volatility, your overall risk is a lot lower than if you are gambling on individual stocks. But let's talk about the main concern that I'm seeing when it comes to index funds. And that would be the potential of us seeing another lost decade. And what a lost decade is a period of 10 years where the stock market remains relatively flat or even experiences a loss. Now, this idea was first coined during the Japanese economic crisis. And the Japanese stock market has never recovered. It's currently lower today than it was 30 years ago. Here's some other examples of similar market stagnation. In 1954, the S&P 500 was the same price as the peak in 1928. The S&P was also higher in 1968 than it was in 1978. And if you had invested in 1999, the year I was born, it would have taken you 10 years to recover from the dot-com bubble. But fast forward to the current day, we're seeing a lot of investors and analysts saying that we could see something like this happen over the next decade. Notably, Ray Dalio, Charlie Munger, and their narrative is that stocks are currently so overvalued and we've gone up in price so significantly so fast that we may expect to see lower overall returns moving forward. They also say that interest rates can't stay this low forever. And as rates go up, the cost of debt increases, and that eats away at company profits, which in turn hurts the stock market. And here's the thing, when we think about the stock market, we're really only thinking about 5 companies, when in reality, there's over 6,000 publicly traded stocks. These 5 companies are Facebook, Amazon, Google, Apple, and Microsoft. And these 5 companies make up a quarter of the entire valuation of the top 500 companies that dictate the stock market. And in my opinion, that's a huge problem and a massive threat to the stock market and to your personal investment returns. Let's look at an example. Most people think that the stock market went up on the second half of 2020, but that's actually not true, because while those 5 companies did go up, the 495 other companies collectively went down. They lost value. Now, no one really knows what will happen, but it's very possible that these 5 companies could crash the entire stock market. Now, at this point, you might be wondering, what is a better investment if not index funds? Now, I really quickly want to say that I am not a financial advisor. This is not financial advice, and this video is for entertainment purposes only. But when you're making investment decisions, try and think down the road. Try and be future oriented and think long term. And what I mean by that is to look at emerging industries and trends for consumer behavior. Now, here's a list of some of the top emerging industries that could make for very lucrative investments, possibly way more lucrative than the average index fund would be. These industries include EV, or electric vehicles. They include battery technology, cryptocurrency, 3D printing, biotechnology, artificial intelligence, fintech, space and satellites, rare metals, semiconductors, energy infrastructure, renewable materials, data storage and management, online gaming and betting, and one of my favorites, which is plant-based foods. To yield the highest investment returns, you have to think 5 or 10 years down the road. An example that I personally did is about 18 months ago when I first heard the announcement that Disney was launching their streaming service, Disney Plus. I went ahead and bought heavy into Disney stock with the expectation that they would take significant market share away from Netflix. And this long-term investment actually performed very well for me, with Disney Plus being the main catalyst for the stock growth. Because here's the thing, even if we do experience a lost decade, and even if the overall market stagnates over the next 5 or 10 years, individual stocks still hold a lot of growth potential, meaning that your investments could potentially see significantly more growth than if you had just invested in the index funds. But even with individual stocks, people worry that if we're actually in a bubble, then buying anything right now can actually hurt us.
Whoa! Hey, don't I got a say in this?
So if you're wondering this, something that might encourage you is that Goldman Sachs actually sees no sign that we're in a bubble. Goldman feels like we have historically low interest rates, and we also see an increase of investors taking risk and being in the market. And a main difference between today and the previous bubbles we've seen in the past is that tech stocks primarily are making a lot of revenue, which is significantly different than the dot-com bubble, because back then, stocks were trading atmospherically high, but they were making no income. They were only trading at those high levels on the expectation of future cash flow. So that right there is pretty comforting to know. Also keep in mind that when we talk about risk, we're also talking about potential reward, because you can't have high returns without taking necessary and calculated risks. Other comforting news is that growth output is improving and increasing, especially in the US. The United States household net worth is at its highest in history. And I know that seems hard to believe given how tough of a year 2020 was. But with asset price inflation, with the stock market continuing to go up, mainly because of the Federal Reserve, and also because of real estate prices continuing to skyrocket and more households doing refinances, there is a train of thought that we could see the stock market continue to rise, especially with all the excitement that investors have right now. But I want to present a counter argument for index funds, because in no way do I think index funds are all bad. Index funds provide an easy entry to investing, and they also have less volatility and less risk associated than individual stocks do. So let's look at a worst case scenario. If you invest in an index fund and we do see a lost decade occur. So if you had invested over the 12-year period from 2000 to 2012, your total return over the 12 years would be 4.66%. Now, if you include dividends into that calculation, it jumps up to 32.53%. 3%. And hey, that's not bad, but that's assuming you only invested one time. Now let's say you dollar cost averaged into the market. Because remember, even in a lost decade, the market is volatile. It goes up and it goes down. So if you are consistently buying the dips and averaging into the market, your return will be better. In this scenario, you would average a 24% return over the 12-year span. And then when you factor in dividends into that, you would get a 42% increase over that 12-year span. For a worst case scenario, and for a lost decade, that's not necessarily bad either. So if you've made it to this point of the video and you still want to invest into an index fund because it's less risky, it's less volatile, and less stressful overall, what are the best index funds to invest in? Well, to answer that question, we have to look at the expense ratio of index funds. And the expense ratio is basically how much the index fund charges you essentially. It's almost like a maintenance fee. So the S&P 500, for example, has an expense ratio of 0.03%, which works out to being $3 for every $10,000 that you have invested annually. VT Sachs is another good index fund that has an expense ratio of 0.04, which is $4 for every $10,000 annually. The NASDAQ QQQ is an index fund of tech stocks, and it has a little bit higher of an expense ratio at 0.2%, which works out to being $20 for every $10,000 annually. And lastly, I'm sure you've heard of ARK Invest index funds. Now, these index funds have a higher expense ratio at 0.75. So that means for every $10,000 you have invested, you're going to have a $75 fee every single year. And that goes for all of ARK's funds. The ARK Genomic Revolution, ARK FinTech, or just the ARK Innovative ETF. Now at this point, you might be asking, are mutual funds better than index funds, especially considering that index funds might stagnate over the next decade? Well, the answer is an astounding no. For anyone that doesn't know, a mutual fund is an actively traded portfolio. Basically, you have a manager that chooses individual stocks and makes their own index fund for you with what companies they think are going to perform well. But the reason that mutual funds are not a good idea is because it has a high cost. And the cost is sneaky. You don't realize how much fund managers actually make and how much it's eating at your profits. Let's look at an example. Up close, it doesn't seem like just 1% in management fees would make a huge difference in whether you can retire or not. But in reality, these fees can put a huge hindrance on our hard-earned cash growing as fast as it could. Let's say you invested $100,000 for 40 years with an average 10% return every single year. That would give you $4,525,926. Now, if you're getting charged 1% in fees, that overall return diminishes to just $3,140,942. That's over $1 million that was forfeited just because of a 1% management fee. And that's assuming just a 1% management fee. Most financial advisors will invest your money in mutual funds with fees anywhere from 1% to 2.15%. So mutual funds, in my opinion, are really not where it's at. And if you're interested in learning more about this, there's a book that I highly recommend by Tony Robbins called Money, Master the Game. It's one of the books that I'm currently listening to right now. And thanks to Audible, if you click the link down in the description and it's your first time signing up, you can get this book 100% for free and keep it for the rest of your life. So overall, my thesis about index funds is long-term, they still make for a great store of wealth, and they still will provide some growth for your investments. But I really don't see them providing the same growth as we've seen in the past. Because remember, there's no such thing as infinite returns. But you have to know your individual level of risk tolerance as an investor. But if you're looking for the highest possible growth, then I would invest in emerging industries and high conviction companies. Make sure to do your research and only invest in things that you understand and you could see growing. For me, I personally am investing about 70% into individual stocks, about 25% into index funds, and that's mostly in my Roth IRA, which is for retirement, and then about 5% into cryptocurrencies like Bitcoin and Ethereum. Wow, that was a lot of information. If you made it until the end, thank you so much for watching, and if you haven't already, make sure to decimate the like button, smash the subscribe button, and make sure to add me on Instagram because I'm posting there almost every single day. Thanks, guys. Let's go. Stonks to the moon.